we've been discussing issues around what the various practitioners within the sectors of the financial system have had to contend with in terms of broad sweeping reforms. Mr. Daniels, let's just start with you in this part of the conversation. There is a major cleanup of banks that's currently underway, but what kind of cleanup is needed for the insurance industry because of that whole life assurance type relationship?
Thank you very much. There's been a lot of call for the National Insurance Company to do exactly what the CBN has done. And I've always explained that the problem of the banking sector is quite different from that of insurance. I think for insurance, the major issue we have is deepening insurance penetration. Okay, the kind of event that led to CBN intervention, we haven't seen that kind of thing in the insurance industry, but that is not to say it can't happen. What we've done in the recent past is to increase our surveillance and monitoring. Statutorily, we are required to inspect on-site inspection of insurance companies once in 2 years. We've had to increase that to twice a year. Within the last 12 months, we've done forensic on all the insurance companies as a prelude to our reviewing their 2009 accounts, because we really needed information ahead of the submission of the accounts. So we are doing everything possible to ensure that the insurance does not go the banking way. The reason is simple. Insurance is sensitive, insurance is growing. Whatever happens in the banking sector, people will still go to the banks. But insurance is not such a compulsory buy. People can really do without insurance, except for the compulsory element, which is motor insurance. So really, we are doing everything possible to ensure that the insurance industry does not run into crisis of the banking sector, because if that happens, that probably will take us 10 years back.
I mean, the governor's here and he can elaborate on this one, but basically there's talk of changing the principle of universal banking in Nigeria, and there are concerns that this ultimately is going to change the relationship between banks and insurance houses and the incestuous relationship, for lack of a better word, between the two. What do you see going forward? What are your views about some of the changes that may happen?
I think we applaud the recent decision of the central bank to stop most of the banks going into other areas that are not core to their business. Insurance is one of these areas. And this is making it easier to supervise and also for the banking entities to concentrate on their core business. Okay, so it's making supervision quite easier, monitoring of insurance entities, and I hope that by the time frame given by the central bank elapses, we'll have a clear separation of insurance entities from the banking entities. Universal banking on its own is not a bad. Of course, that is the way to go, but because of the nature of our financial system, I think we really need a little more time. We need study, we need information to go universal banking.
Well, I'm not sure about universal banking itself not being bad. It's pretty controversial. But I think the most important thing about this is that it goes beyond banks, okay, and it goes into understanding the real problems underpinning financial crisis in Nigeria. The banks have been overburdened with the responsibility of being the one supermarket that provides all the financial requirements of the country. So banks have become venture capital companies, they've become private equity firms, they've become insurance companies, they're doing retail banking, they're doing mortgage banking, they're doing wholesale banking, they're doing advisory services, and all of this, all the funding requirements are short-term current and savings accounts. So you've got these huge risks of maturity transformation. Depositors' funds are taken and put in private equity through booking offices called investment banks. Okay, they're taken and they're booked as venture capital through all sorts of venture capital companies owned by the banks. Those monies are used to finance capital market interventions through stockbroking firms and also through underwriting by issuing houses. Now, so you take these current accounts, which are short-term and which were placed in the banks for safety, and you're taking all sorts of risks that should be taken by more enlightened investors. And all we've said is, look, you need to develop proper venture capital companies. You need to develop proper asset management companies. You need to develop proper insurance companies. If I take my money and I want to bet it in the capital market, I go to an asset management firm. If I want to find my savings in a year, I go to a bank. And that's extremely important. And I don't think, as far as the risk management principle is concerned, I have seen any compelling argument that says that a system that allows one bank that has short-term funding sources to operate in areas that are completely disconnected from the nature of the funding is superior to one that separates them.
May I ask you just to clarify a point that many players within the sector are confused about or concerned about, is that ultimately these sweeping reforms and changes on universal banking principles is going to change the so-called group structure of an entity. And there is a sense that people need clarity as to what some of those changes are going to be, and if indeed there are going to be any changes.
Well, the principal thing is that what you'd find is that my understanding is that many of the banks in Nigeria are simply going to remain banks. I've run a bank before. And many bank CEOs will be the first to admit that these insurance and asset management businesses, frankly, contribute very little to income unless they have been used as booking offices and arbitraging depositors' funds. It's fine if you can take these billions of deposits and go through a stockbroking firm and trade in a capital market where there's speculation and a bubble, you'll make a lot of money. But if you are actually going to operate them as independent entities, their contribution to your income is very little compared to what you make from normal banking business. So that's the first thing. So many of these banks are simply going to hive off these. Now, for those who, for example, you've got banks like Standard Bank that started as an investment bank. So I would expect that their capital market operations are a major part of their business. What would probably happen is that they could either decide to be a merchant bank or they could decide to retain both a merchant banking and a commercial banking license. Now, what we've said is banks can be part of a holding company structure, but the capital of the bank and the depositors' funds cannot be used for any business other than banking. We do not regulate the shareholders of banks. Those who own banks can own an insurance company. They can own a stockbroking firm. That's not a problem. They will not own a registrar's company. We will not allow the bank to be part of a holding company that has registrars because of things that have happened in the capital market using registrars. But for those areas that they can be involved in as a financial holding company, we don't have a problem. But the deposits of the banks cannot be used for those businesses. They can use their capital and they can raise money from investors in those businesses. So if you take your money out of a bank and put it in the asset management firm, and the asset management bank firm goes under, I don't have a problem. But so long as the central bank is a lender of last resort and bailing out banks, the central bank is going to decide what the banks can do with their money.
Okay, you have an opinion?
I was just going to add that one of the things that we need to build going forward as a country is really that the financial services truly work for the real sector. And this model allows the financial services to work for the real sector.
And maybe in addition to that, one of the key issues where this particular structure will support is the capital. Under the previous structure, capital can be leveraged through various institutions, and therefore it becomes extremely difficult for you to know specifically whether that institution is fully capitalized, because the same capital can be used in different groups. Recently, the BAL committee has just issued the initial draft on BAL 3. Right. And BAL 3 is basically talking about providing sufficient capital. So I believe this structure is consistent with what, indeed, all other banks providers worldwide are looking at.
Now, the governor's just raised a concern, but a concern that you're all trying to address, and that is what he terms banks being overburdened in Nigeria. And we know that on the Nigerian Stock Exchange, for instance, the largest constituents of listed entities are banks. So they're already beginning to have a bit of a tension, because apparently banks contribute less than 5% of GDP, and yet in terms of lending facilities, they are the nucleus of the vehicles through which businesses can be funded in this country. The issue right now is about the work that needs to be done to broaden the profile of listed entities on the Nigerian Stock Exchange and making it attractive for non-listed companies to do so. It goes back to governance, it goes back to integrity, But if we want stability, we have to remove the burden off the banks. How are you going to address this one?
There are a number of ways. Indeed, under the auspices of the National Economic Management team that is chaired by the Honorable Minister of Finance, there is an initiative to seek ways to deepen and broaden our capital markets. And one of those initiatives is to seek ways to bring companies, to encourage companies from other sectors to participate and list on the Nigerian Stock Exchange. What we've seen is that there have been certain sectors that have been extremely successful in our country, where you haven't seen the companies list on the Nigerian Stock Exchange, and in many cases they're listed on the stock exchange in other markets. One of the sectors is the telecommunications sector, where you've seen whether it be Glo, MTN, Etisalat, and others have been extremely successful in building businesses. Indeed, I'm told that MTN makes 40% of its profits from Nigeria, yet it's not listed on our exchange, it's listed on the South African exchange. So we must create conditions that will encourage an MTN to list on our markets. But I think it's also great for an MTN's brand, because what it will do is democratize that success so that the average Nigerian can feel that they're participating in the success of a company that is in a strategic sector, that is a profitable sector like telecommunications. And I would say the same thing for the upstream oil and gas companies. There's a real opportunity for a Shell, for a Chevron, for a Mobil to list on the Nigerian Stock Exchange. And what we would like to do is interact with these companies on a one-on-one basis to try and understand what it is that is not encouraging them to list on the Nigerian Stock Exchange. But we do think it's also great business for them, because then Nigerians can feel a part of their success, and that supports their brand and their businesses.
Can I say something on that? I think it's important that we also realize the limits of what we can do as regulators. And there's a conversation that has started and that must continue, which is a conversation between the financial system and the managers of other sectors of the Nigerian economy. You're not going to have manufacturing firms listed on the stock exchange if you don't have a thriving manufacturing industry. You won't have that if you don't implement your power reforms and provide the right infrastructure. You're not going to have agricultural firms on the Nigerian Stock Exchange if you don't have large agricultural companies, and that is agricultural policy. So there are limits to how far we talk about telecoms today because we had the telecom sector reforms. But after the oil companies, after the manufacturing companies, then what? 42% of our GDP is agriculture. We are so far from having an agricultural company that can be listed on the stock exchange. So the broader economic policy environment that actually builds big businesses has to precede the listing on the stock exchange. And this is really where the financial system has to not run too far ahead of the rest of the economy.
An issue here, and maybe the two of you can address it. Some people say yes, all of that withstanding, but there are other concerns, for instance, like making it cost-effective and efficient to raise capital through the Nigerian Stock Exchange. Those also become challenges. For instance, somebody was saying you just look at the recent listing of Dangote Cement, and it's lifted the capitalization almost by 2-3 billion naira. So you do have companies that are good performers that are not listing because they don't see it being a channel through which they would really get value for money, value for investment, growth and development. They can do it independently. So there is something about the system inherently that needs to be rectified.
Our view is that there needs to be greater awareness. We've had a number of interactions with issuing houses and issuers to try to understand what those issues are. And in many cases, they're not about cost, they're just about understanding the process of listing, understanding the benefits of listing. We held a forum in the middle of the year with a number of companies and issuing houses. And some of what we heard from the likes of the Dangote Group or Honeywell and others that have recently come to the market are the benefits of listing, because it creates, in a sense, opportunities both locally and internationally for your companies to be better understood. And that, what we've been told by some of them is that it's brought them the kind of worldwide recognition that they would not have been able to get if they had not considered listing on an exchange. Yes.
Mr. Ahmed, I want to raise issues now about the pension markets or the pension funds themselves, because in many other economies, they are literally the key investors on a stock exchange. Big debate at the moment, why the reticence to allow pension funds to invest abroad?
What we did as a country, or perhaps as an industry, was to say that we needed to first, this is entirely a new system. We needed to have the buy-in of Nigerians to understand why this reform is important. And basically, as of today, we have barely 4 million Nigerians that have signed on to this new scheme. The second issue, of course, is the fact that we have infrastructural challenges in this country. And therefore, we should be focusing on, first, developing our infrastructure, because the performance of the pension assets depends on the macroeconomic stability, the growth of the economy. And if you can have that, obviously you have the challenge. The third reason is that we needed to build expertise, both as regulators and pension asset managers, to even understand our local market. As of today, we have challenges of investment management skills. We needed to develop that. And having done that as part of transition, then we start to look outside. And this is consistent with practice in so many countries that started the scheme we've been doing. So it is a conscious effort, which we believe we need to move gradual and as conservative as possible.
Okay. Governor, is the Naira in trouble?
No. No, it isn't.
Many people are baffled.
No, it isn't. I mean, why am I not surprised that you're asking that? Look, if you look at the fundamentals of the Nigerian economy and what drives exchange rates, you've got oil price today above $80 a barrel. The outlook is very good. Oil demand in China outstripped GDP growth last year. And the outlook is for increased demand and strong demand, especially from China. Our production levels have gone to over 2 million barrels a day, from under 1 million barrels at the height of the Niger Delta crisis. We did have a period in the last few weeks of elevated demand. We've analyzed that demand. We know exactly where it came from. It was temporary. It's been totally addressed. What we've done is we've also put in place, and we are putting in place, a system that allows the central bank to provide a hedge to banks if they write forwards and options with their customers. So if anyone wants to speculate against the Naira, or if anyone wants to hedge a risk, you can hedge it today. If you look at the bids, on Monday, the demand came down to 270 million. Yesterday, it was 253 million, just about what we think is the normal demand. And we'll continue to meet that level of demand comfortably at these rates.
I'll tell you why I'm asking you about the Naira being in trouble, because you were alluded earlier on to some of the more pressing structural problems in the Nigerian economy that starts to have bearing on other elements of monetary policy, for instance. And, within the media, we're watching the situation between the dollar and the Naira. And it's baffling for many experts as to the fact that Nigeria's reserves are held largely in dollars. Nigeria trades oil in dollars. If anything, the Naira should either be tracking the dollar, or there should be some kind of parity. But irrespective of the dollar weakening internationally, the Naira is weakening against the dollar. And those in the know say this is happening because Nigeria is not a productive economy. I think we've all conceded to that fact. And that the structural imbalances of this economy are ultimately going to have bearing on the currency, which will ultimately have bearing on the capital markets and the attractiveness of this economy, et cetera, et cetera. I don't need to go into all of that. So the interventions that are needed, because the CBN has also said we can't continue to buffer this currency. We don't have the reserve capacity anymore.
No, I didn't say that. And I think I had a big fight with Reuters over that. It would be a very irresponsible central bank governor who would say that he would defend the Naira at a particular level, irrespective of the costs. Yeah. And I said, we have never said we will keep the Naira at a certain level, irrespective of costs. but there's no compelling reason at this moment to depreciate. Now, on the second issue of people in the know, it's strange how experts, make statements that really are uneducated. The nominal exchange rate, okay, is one thing. The real exchange rate is another. You have a country, our inflation moved up from 10% to 14%. Okay, that is a 400 basis point increase, okay, and that's really 40% from a base of 10%. The US is a zero inflation area. Now, if you just did real exchange rates, the naira has actually appreciated against the dollar. Okay, you can't have a high inflation environment and a low inflation environment and then make a judgment based on nominal rates that have been fairly stable without looking at inflation differentials. So in real terms, there has not been a depreciation. And even in nominal terms, the naira has been in a band of 115 naira plus or minus 3% for a year. We said we'd keep it in that band. It has never breached that band. If it got to 160, 170, without a deliberate policy decision, then that'd be a source of concern. Now, if we feel there is a need to allow the naira to ease, we would let it ease. We don't see at this point in time any compelling reason for a depreciation, and we think stability is so important for investments, it's important for planning, it's important for inflation, and we are as an economy, our growth model is domestic demand-led. We're not an export-led economy. So people look at CNBC and they see the debate on the rand and the dollar. I mean, the South African companies would make a lot of money if the rand weakens because they can export. Nigerian textiles will not make money, irrespective of the value of the naira, if you don't fix power and infrastructure. They're dealing with more serious problems than exchange rates. It's about, they're not even producing, they're not even alive, not talk of competing. So we've got to fix power, we've got to fix infrastructure. If you depreciate the naira now, all that you do is increase the cost of production to manufacturers and increase their lack of competitiveness.
We'll continue talking about the general macro strategies needed for the economy. Still on the naira, would you be open to a currency trading platform possibly created?
I don't mind any kind of innovation so long as it does not expose the currency to speculation and hacking. I don't see any reason for anyone to buy dollars if those dollars are not being bought to purchase real goods and services. I'm not going to support any system that allows people to just come and trade. That is what killed the Asian economies in the 1990s, and we're not going to allow it.
Okay, Mr. Ahmed, the governor is raising again another issue about the very important need to fix this economy structurally, because once the economy is a lot more productive, then you can at least deal with the stability of the currency, because right now there are lots of issues around imported inflation, etc., etc. And this is where pension funds come in, because by being being a big constituent in terms of holding government securities, you're in a position to help this government raise money for some of its more ambitious infrastructure projects. Going forward, what do you see the relationship being between the pension funds, capital raising, the private sector, and government?
Basically, what we have done was to, in terms of our investment strategy, for instance, we don't have cap on government bonds. In other words, 100% of pension assets can be invested in government bonds. Recently, we just reviewed our investment regulations. They're actually on our website. We're still receiving more comments. And we intend to ensure that at least we channel pension assets into those assets that will also promote growth in the industry. Infrastructure, for instance, is one of the issues. We've received comments, and we're basically reviewing those comments. Beyond that, of course, as an industry, our focus is on safety, because we're dealing with claims of individuals that will eventually retire, and then returns. And the returns are relatively okay compared with perhaps if we were to invest even outside Nigeria. So as an industry, we would continue to work with our colleagues and ensure that pension assets are invested in regulated markets, secured, and also long-term. As of today, one of the challenges we face, we just had an assessment by an external consultant who was the former president of International Organization of Pension Supervisors to do a review of our industry. And one of the challenges we identified were that our pension fund administrators are short-term in nature. In other words, we seem to focus on short-term issues. And the reasons are obvious. One, most of us are from the banking industry or for stockbrokers. And the financial services industry is bank-based. So we are coming out from a short-term perspective to a long-term perspective. And this is one issue which we intend to address, obviously. Thank you.
Go ahead.
Well, just to write it to that, and I think it goes back to your first question on the central bank and development. If you look at the new guidelines by PENCOM, for example, on their own, they will not put the money in infrastructure. Okay, so for example, he's kindly allowed pension funds to put 40% of their money in infrastructure, but these infrastructure bonds have to be rated investment grade. Now, you know that no rating agency is going to rate a new power project or a new infrastructure project BBB or AAA. Now, the central bank has said we're willing to play a role of adding our guarantee to that paper. Okay, so for the first 2-3 years, while you have a power project and infrastructure project, before it gets a rating, pension funds can actually release the money into those projects, 20-year money. After 3-4 years, the project gets a rating and is able to continue on its own steam, and that guarantee is not required. So the central bank does have to play that developmental role, so long as it is not going to remain there for 20 years. But for the 3-4 years required for the capital market to take over, we need to use the country's balance sheet. That is really the mindset.
Thank you very much. It's time for us to take a break. We'll be back with more from the 16th NESG discussing issues of regulation. Stay with us.